Welcome to The Explainer. Today, we're diving into a really dramatic story of dizzying heights and a devastating fall, the Great Silver Crash of 2026. We're going to unpack what sent this precious metal soaring, what caused it to plummet, and what it all tells us about the markets.
So, what's the big mystery here? The one question that just left traders completely stunned was this. How did one of the most incredible rallies in recent memory
Suddenly shatter and turn into a historic crash, seemingly overnight? It's a classic story of market psychology, really, where pure euphoria just flipped into total exhaustion. Let's break down every piece of this puzzle.
All right, let's get right into it. To even begin to understand the crash, you first have to understand the incredible boom that came right before it. And as you're about to see, silver has a bit of a history of these dramatic cycles.
You know, this timeline really shows a clear pattern. Silver seems to shine its brightest during times of major economic uncertainty, from the runaway inflation of the 70s to the financial crises of the 2000s and all that pandemic stimulus in the 2020s. You could say fear has always been like rocket fuel for silver's price.
So, leading up to the crash, the price surge was so fast it was almost vertical. Analysts were ringing alarm bells left and right, calling the rally unsustainably parabolic, which is really just a fancy way of saying the chart line was going straight up. The market was dangerously overheated, and while maybe a correction was expected, nobody predicted just how severe it would be.
At its absolute peak, the price per kilogram on India's MCX exchange hit a staggering record high of 4.20 lakh rupees. Now, a number like that, it doesn't just attract seasoned investors. It pulls in massive speculative interest, adding even more fuel to an already fragile market.
And now we get to the dramatic turning point. As the saying goes, the higher you climb, the harder you fall. And for silver, man, what a fall it was. In a single day, the market went into an absolute free fall. We're talking a staggering 15% drop intraday that wiped out weeks of gains in just a few hours.
To put that into perspective for you, this meant a plunge of nearly 80,000 rupees per kilogram. For traders who were holding leveraged positions, borrowing money to make bigger bets, the losses were just catastrophic. The speed and the sheer ferocity of this collapse were so out of the ordinary that it was immediately labeled a watershed moment. The shockwaves were felt all across global markets, from COMEX in New York to the MCX in India, cementing its place as one of the worst single-day collapses ever recorded.
So, the crucial question is, what on earth could trigger a collapse this violent? Well, the first major factor was a fundamental shock to the entire market's expectations.
Now, what's really interesting here is how a single policy term can move billions and billions of dollars. A hawkish stance just means a central bank is focused on fighting inflation with higher interest rates, and that makes that country's currency, in this case the US dollar, much, much stronger. And here is the chain reaction, step by step. The U.S. administration nominated Kevin Warsh as the next Fed chair. The market immediately saw him as a hawk. That sent the U.S. dollar soaring. And since silver is priced in dollars, a stronger dollar instantly makes it more expensive for buyers using other currencies, which just crushes demand and triggers the sell-off. It's wild. A single political appointment repriced risk across the entire system. But that news from the Fed, that was just the spark. The market itself had become a powder keg, just waiting for a reason to blow. And that brings us to the technical side of the story.
This quote just perfectly captures the human psychology behind all the numbers. The market swung from extreme greed to sudden fear. This kind of violent shift is often said to flush out the weak hands. That is, the newer, more speculative traders who jumped in late and just couldn't handle the intense volatility.
It really was a perfect storm. Technical indicators had been screaming that the market was overbought for weeks. Once the selling started, automated algorithms and stop-loss orders took over, creating a cascade. At the same time, exchanges increased margin requirements, which forced traders to sell. And finally, you had the big institutions rushing to book their massive profits. Each factor fed on the others, turning what should have been a normal sell-off into a self-reinforcing liquidation event. After a crash this dramatic, the big question on everyone's mind is always, where do we go from here? Is the bull market over, or is this whole thing just a reset?
Well, history gives us a pretty sobering perspective. Silver's most spectacular rises have often been followed by absolutely brutal falls. After the 1980 peak, it crashed almost 89%. After the 2011 peak, it fell 72%. These weren't small corrections. We're talking punishing multi-year bear markets.
And this perfectly lays out the two competing stories now facing investors. On the bullish side, you've got long-term fundamentals that look incredibly strong, with surging industrial demand from green energy and AI, combined with a structural supply deficit. But on the bearish side, the short-term market psychology is just severely damaged. Investors are now cautious about volatility and the potential for a stronger dollar. So that leaves us with the ultimate question. Was this crash a painful but necessary reset that created a historic buying opportunity, or was it a massive warning sign that the speculative frenzy is over? The answer will define the next chapter for one of the world's oldest and clearly most volatile assets.